fundamental idea in economics, the invisible hand theory. This concept suggests that markets, through the push and pull of demand and supply, naturally find a balance all on their own. Our first question asks who introduced this influential theory. Think about the options as we move forward. Adam Smith introduced the idea of the invisible hand back in 1776. It's the notion that when individuals chase their own profit, they unintentionally help balance the market as a whole. This happens without any direct government control. In other words, personal self-interest can guide the economy towards stability, even if that's not the goal. It's a powerful concept that shapes how we think about markets today. Let's look at a key question about economic systems. Which term fits an economy where individuals have complete freedom to produce and sell goods, with no government interference in market competition? We're comparing 4 options: command economy, mixed economy, laissez-faire economics, and protectionist economy. This question helps us understand how different economies balance freedom and control in the marketplace. Think about which system truly lets the market operate without any government hand. Laissez-faire is a French term that means leave alone. It describes a market where businesses operate with minimal government interference. In this kind of system, competition is the main force deciding which companies thrive and which ones don't. It's all about letting the market find its own balance without outside control steering the outcome. This idea is central to understanding how free markets work. Let's look at the Kuznets curve and what it tells us about economic growth and inequality. The key idea is that inequality doesn't just move in one direction as an economy grows. Instead, it usually rises at first, as some people benefit faster, but then it starts to fall as growth spreads more widely. So, inequality first increases, then decreases. This pattern helps us understand the complex relationship between development and income distribution. The Kuznets curve shows us an interesting pattern. Inequality tends to increase during the early stages of a country's development. But then, as the country matures and grows, inequality starts to decline. It forms an inverted U-shape when graphed. This concept helps us understand the economic shifts that happen as societies evolve over time. So, the key takeaway here is that inequality isn't fixed, it changes with development. The Laffer curve shows us a key relationship in economics between tax rates and tax revenues. It illustrates how changing tax rates can impact the total revenue the government collects. Too high, and revenues might actually fall because people work or invest less. Too low, and revenues are limited by the small tax base. This curve helps us understand the balance needed to optimize tax policy. So the 2 variables it connects are tax rates and tax revenues. Let's talk about how tax rates affect total revenue. You might think that raising taxes always brings in more money, but that's not the case. Beyond a certain point, higher rates actually lead to less revenue. Why? Because people start evading taxes or lose the drive to work and produce. So there's a tipping point where increasing taxes backfires. This idea helps us understand why finding the right balance is so important. Let's take a moment to look at these different economic curves. Each one tells a unique story about behavior and markets. But today, we're focusing on the curve that helps us tell the difference between normal goods and inferior goods based on how consumer income changes. This question asks us to pick which curve does that. It's a key concept in understanding how people adjust their spending as their incomes rise or fall. Engel's curve shows us how a person's income affects how much of a product they want to buy. As income changes, demand shifts in predictable ways. This concept helps us understand consumer behavior, how spending patterns evolve with earnings. On this slide, the correct answer highlights that connection clearly. It's a key idea for anyone studying economics or market trends. The Phillips curve shows us an inverse relationship between inflation and unemployment. When one rises, the other tends to fall. But this connection usually holds true only in the short run. Over the long run, other factors come into play, and the relationship can break down. Understanding this distinction helps us see why policies might work differently depending on the time frame we're considering. The Phillips curve shows us a connection between inflation and unemployment, but only in the short run. Over time, this relationship breaks down. It doesn't hold steady in the long run. That's why the correct answer here is B. It reminds us to be cautious about applying short-term patterns to long-term economic predictions. In donut economics, the goal is to find a balance, a safe and just space where the economy can thrive without overshooting ecological limits or falling short on social needs. This means staying within social foundations like healthcare and education, while respecting ecological boundaries like climate and biodiversity. It's not about high taxes or trade surpluses. Instead, it's about meeting everyone's needs fairly without harming the planet. That's the core idea behind this approach. Let's explore donut economics, a way of thinking that balances what people need to thrive with the planet's limits. It's about staying within a safe ecological boundary while ensuring everyone meets a social foundation for well-being. This approach challenges traditional ideas of endless growth, asking us to rethink how we measure success in the economy. In this section, we'll connect these ideas to national income and economic growth. When calculating GDP, we want to avoid counting the same value more than once. This is called double counting. Here we have 4 options: the value of the final bread sold, the value of flour used to make that bread, the value of government services, and the value of exported goods. The key is to exclude the value of intermediate goods, like the flour, because its worth is already included in the final product. So to keep GDP accurate, we leave out the flour's value. When we measure GDP, we only count final goods, the products ready for consumption or investment. Intermediate goods, like flour used to bake bread, aren't included. Why? Because counting them would mean double counting their value. This keeps our economic picture clear and accurate, focusing only on the end products that truly reflect economic activity. Let's look at the difference between GDP and GNP. GDP measures the value of all production within a country's borders. That's a territorial concept. GNP, on the other hand, focuses on production by the country's residents, no matter where they are in the world. So, while GDP stays within borders, GNP follows the people. This distinction helps us understand economic activity from 2 important perspectives. GNP, or Gross National Product, measures the total value created by a country's residents, no matter where they actually are in the world. It's about the income earned by people and businesses from that country, whether they're working at home or abroad. This makes GNP different from GDP, which only counts production within the country's borders. So, when we talk about GNP, we're focusing on the economic activity of the nation's people, not just the place where it happens. Let's break down the concept of the GDP deflator. It's a key economic measure that helps us understand inflation by comparing 2 types of GDP, real and nominal. Specifically, the GDP deflator is calculated by dividing nominal GDP by real GDP. This ratio shows how much prices have changed over time, giving us a clearer picture of economic growth without the noise of inflation. It's a simple but powerful tool in economic analysis. The GDP deflator is a key measure we use to understand the overall price level in an economy. It's calculated by taking the nominal GDP, that's the total output valued at current prices, and dividing it by the real GDP, which adjusts for inflation. This ratio gives us a clear picture of how prices have changed over time, helping us separate growth from rising costs. It's a simple formula, but a powerful tool for economic analysis. Let's look at what counts towards India's national income. We have 4 options: work done by a housewife, legitimate lottery income, wheat produced by a farmer for self-consumption, and the sale of a second-hand car. The question here is, which of these are actually included when we calculate the country's total economic output? Understanding this helps us see how national income reflects real economic activity and what might be left out. When we talk about economic activities here, we're including things like farming your own food activities done for self-consumption. But not everything counts. Care work, which is unpaid, and transfer payments, like lotteries, are left out. This distinction helps us focus on what really drives economic value in this context. So the correct answer to this question is C. Green GDP gives us a clearer picture by adjusting the standard GDP to account for environmental costs. It deducts expenses like government subsidies that might encourage harmful practices. It also factors in natural resource depletion and pollution, the hidden costs of economic growth. Import duties and corporate taxes are part of the broader economic picture, but green GDP focuses on the environmental impact, helping us see growth in a more sustainable light. Green GDP is a way to measure economic growth while factoring in the environmental costs that usually go unseen. It accounts for the damage or depletion caused during production, things like pollution, resource use, and habitat loss. This approach gives us a clearer picture of true progress, beyond just dollars and cents. It helps us understand whether growth is sustainable or if it's coming at too high a price for the planet. When we talk about real GDP in India, we're referring to a measure that adjusts for inflation by using prices from a specific reference point. This reference point is called the base year. It's the year whose prices stay constant, allowing us to compare economic output over time without price changes distorting the picture. So, the base year is key. It's the foundation for calculating real GDP accurately. Real GDP helps us see the true growth of an economy by stripping out inflation. Instead of using current prices, it values what's produced today at prices from a base year. This way, we get a clearer picture of actual production changes without the noise of rising prices. It's a key tool for comparing economic performance over time. Let's look at the four main economic sectors, from primary to quaternary. The question here asks which sector involves directly extracting natural resources, things like mining and quarrying. That's the primary sector. It's all about getting raw materials straight from the earth. The secondary sector processes those materials, the tertiary sector offers services, and the quaternary sector focuses on knowledge and information. Understanding these sectors helps us see how economies are structured and how they evolve over time. Extractive industries work directly with natural resources, things like mining, fishing, and forestry. Because they focus on raw materials, they're part of what's called the primary sector. This sector forms the foundation for many economies, supplying the basics needed for manufacturing and other industries. Understanding this helps us see how fiscal policy and budgeting decisions can impact these vital activities. Let's look at what a revenue deficit really means. It happens when the government's revenue expenditure is higher than its revenue receipts. In simple terms, this points to dissaving. The government is spending more than it's earning in regular income. This isn't about borrowing or capital investment, but rather the day-to-day financial gap. Understanding this helps us see the bigger picture of fiscal health and why managing revenue is so crucial. When a business spends more on daily operations than it earns, it's called dissaving. This means the company is using up its savings or reserves just to keep running. It's a warning sign, not sustainable in the long run. Here, the correct answer highlights that spending beyond earnings leads to dissaving, which can quickly erode financial stability if not addressed. Let's talk about effective revenue deficit, or ERD. It's a way to measure the real shortfall in government revenue, but with a twist. To calculate ERD, we exclude certain items from the revenue deficit. The question here is, which of these do we leave out? Is it subsidies on fertilizers, grants to states for capital assets, salaries of government employees, or interest payments on past debt? Understanding this helps us see the true fiscal gap more clearly. Here, we're looking at how ERD handles grants that, although counted as center expenditures, actually lead to asset creation for the states. This means the money isn't just spent, it's invested in building something lasting. Understanding this distinction helps clarify how funds flow and contribute to state development beyond immediate expenses. The correct answer reflects this important nuance. Let's talk about the concept of the twin deficit. This happens when a country experiences two key deficits at the same time. One is the fiscal deficit. That's when government spending exceeds its revenue. The other is what we're trying to identify here. Is it the revenue deficit, the current account deficit, or the primary deficit? Understanding this pairing is crucial to grasping broader economic challenges. Here, we're looking at a scenario that highlights imbalances on two fronts: internal, which relates to fiscal matters, and external, which involves the current account. Understanding both sides is key to grasping the full picture of economic health. The correct answer here is B, which best captures this dual imbalance. It's a reminder that economies don't operate in isolation. Internal policies and external factors are deeply connected. Let's break down what's meant by the primary deficit. It's the fiscal deficit, but with a key adjustment: we subtract certain payments. Specifically, we take away interest payments. That's because the primary deficit focuses on the government's current spending and revenue, excluding the cost of past borrowing. So, when we talk about the primary deficit, we're looking at the fiscal gap before accounting for interest on debt. This helps us understand the underlying fiscal health more clearly. Let's talk about the primary deficit. This number tells us how much the government needs to borrow to cover its current spending priorities, but it leaves out the costs of past debts. So, it's a snapshot of today's borrowing needs, not the full picture of total debt. Understanding this helps us focus on current fiscal choices without getting tangled in what's already owed. The correct answer here is B. Let's talk about the crowding out effect. This happens when the government borrows a lot, and it starts to impact the rest of the economy. Specifically, high government borrowing can reduce the funds available for private companies to invest or borrow. That means less money for businesses, which can slow down private investment. So, the key idea here is that government borrowing can crowd out private sector activity by limiting resources. When the government borrows heavily, it taps into a limited pool of savings available in the economy. That means there's less left over for private companies to borrow. As a result, interest rates tend to rise, making it more expensive for businesses to invest and grow. This crowding out effect is a key reason why large government borrowing can have ripple effects beyond just public finances. Let's look at 4 key ideas in taxation: the canons of certainty, economy, equity, and convenience. Each one guides how taxes should be designed and collected. The question here is, which canon says the tax burden should match a person's ability to pay? Think about fairness and how taxes impact different income levels. The answer lies in the canon of equity. It's all about distributing taxes justly, based on what people can reasonably afford. The principle of equity is pretty straightforward. It says that people who earn more should give up a larger share when sacrifices are needed. It's about fairness, making sure the burden matches the ability to bear it. So, when we're deciding who should contribute more, this principle guides us toward those with higher earnings stepping up proportionally. In this case, the correct answer is C. Let's talk about different types of tax systems. One key type is a proportional tax, where the tax rate stays the same percentage no matter how much you earn. It's a flat rate for everyone. This contrasts with progressive taxes, which increase with income, and regressive taxes, where lower incomes pay a higher rate. Digressive taxes fall somewhere in between. Here, the question asks us to identify the system where the rate is fixed across all income levels. Proportional taxes apply a single flat rate to everyone, no matter their income. But even with a flat rate, these taxes can feel regressive because they take a bigger slice from those who earn less. So, while the rate stays the same, the impact isn't equal. This is why proportional taxes are often seen as placing a heavier burden on lower-income individuals. It's a subtle but important distinction to keep in mind. Zero-based budgeting flips the usual approach on its head. Instead of assuming last year's spending as a baseline, every dollar has to be justified from scratch each cycle. That means no new money is automatically spent, and the deficit must be zero. It's not about funding only old projects. It's about questioning every expense, every time. This method forces us to rethink priorities and make sure every cost really counts. Every new cycle starts fresh, from zero. We don't carry over past spending habits or patterns. This approach forces us to prioritize what really matters right now, not what seemed important before. It's a clean slate, designed to focus attention on current needs and goals, ensuring resources go where they'll have the most impact. This way, every decision is intentional, not just a continuation of the past. Let's look at different types of budgeting and how they focus on resources and results. Outlay budgeting tracks the money spent. Zero-based budgeting starts from scratch each time. Line item budgeting breaks down expenses by category, but outcome budgeting is different. It zeroes in on the final results and impact, not just the dollars. So, when we want to measure success by what's actually achieved, outcome budgeting is the approach we turn to. Outcome budgeting is all about measuring results, not just tracking dollars. Instead of focusing on how much we spend, it looks at what that spending actually achieves. For example, does the money improve health outcomes? This approach helps us connect budgets to real-world impact, making sure resources create meaningful change. It's a shift from inputs to outcomes, and that's why it's so powerful. Let's talk about the GST Council, the key decision-making body for the goods and services tax in India. It's chaired by one important figure, who brings together the perspectives of the central and state governments. The question is, who leads this council? Is it the Prime Minister, the RBI Governor, the Union Finance Minister, or the NITI Aayog Vice Chairman? Understanding this helps us grasp how GST policies are shaped and implemented. Here, we see that the Union Finance Minister leads this important joint forum, bringing together both the central government and the states. This setup ensures collaboration and coordination on financial matters that affect the entire country. It's a key example of how different levels of government work together to manage resources and policies effectively. Understanding who chairs this forum helps us grasp the balance of power and responsibility in our federal system. Let's break down the main purpose of the Input Tax Credit, or ITC, under GST. It's primarily designed to eliminate what's called the cascading effect. That's when the same goods or services get taxed multiple times as they move through the supply chain. ITC helps avoid this double taxation, making the system fairer and more efficient. While it might also impact government revenue or consumer costs, its core goal is to prevent tax from piling up unnecessarily. Let's talk about Input Tax Credit, or ITC. It's a way for businesses to reduce their tax burden by offsetting the taxes they've already paid on inputs against the tax due on the final product. This mechanism helps avoid double taxation and keeps the system fair. Understanding ITC is key when we explore how monetary policy interacts with taxation and business operations. Here, the correct answer highlights this important concept. Let's look at how the RBI guides credit in the economy. Among these options, the one that's a qualitative tool is moral suasion. Unlike the others, which are quantitative measures affecting money supply directly, moral suasion is about persuasion, the RBI influencing banks, lending behavior without changing numbers. It's a subtle yet powerful way to steer credit where it's needed, without formal rules or rates. This question helps us understand the RBI's toolkit beyond just numbers. Sometimes, the best way to guide behavior isn't through strict rules or numbers. Instead, we use qualitative tools like moral suasion, appealing to banks' sense of responsibility and ethics. This approach encourages them to follow guidelines voluntarily, without the need for hard mandates. It's about persuasion, not pressure, and it can be surprisingly effective in shaping decisions. Let's break down the concept of the marginal requirement in banking. It's essentially the difference between two key values, the loan value and the value of the collateral pledged. This margin protects lenders by ensuring the collateral covers potential losses. It's not about interest rates or cost types, but about managing risk through this buffer. Understanding this helps us see how banks safeguard their loans and maintain financial stability. Here, we're looking at a qualitative approach banks use when lending. Instead of offering the full value of the collateral, the bank keeps a margin, a safety buffer. This margin protects the bank against fluctuations in the collateral's value. It's a cautious strategy, ensuring the loan remains secure even if the market changes. This practice helps maintain financial stability for both the bank and the borrower. Let's talk about the RBI's Liquidity Adjustment Facility, or LAF corridor. It uses several key interest rates to manage liquidity: the repo rate, reverse repo rate, standing deposit facility rate, and the bank rate. Since 2022, one of these has served as the operational floor, meaning it sets the lowest boundary for short-term interest rates. Understanding which rate plays this role helps us grasp how the RBI controls money flow and stabilizes the economy. While the reverse repo facility still exists, the Reserve Bank of India has shifted its focus. Now, it primarily uses the non-collateralized standing deposit facility, or SDF, to mop up excess liquidity. This tool allows the RBI to manage cash flow more flexibly, without requiring collateral. It's a subtle but important shift in how monetary policy operates day to day. Understanding this change helps us see the RBI's evolving approach to liquidity management. Let's talk about what defines a scheduled bank in India. This term refers to any bank that's officially listed in a specific legal schedule. The question here is, which schedule is that? Is it the first schedule of the Constitution, the second schedule of the RBI Act from 1934, the third schedule of the GST Act, or a list of the top 10 PSU banks? Understanding this helps us grasp how banking regulations are structured in India. When banks are included in this schedule, they gain access to specific facilities, like the Liquidity Adjustment Facility, or LAF. This access is crucial because it helps banks manage their short-term funding needs more effectively. So, inclusion isn't just a formality, it's a gateway to important financial tools that support stability and liquidity in the banking system. That's why the correct answer here is B. Let's look at how the digital rupee, or e-rupee, is classified. Is it just a private cryptocurrency? Or maybe a legal tender accepted for all payments? Could it be a coupon for government subsidies? Or is it only used for paying corporate taxes? Today's question challenges us to understand the true nature of this digital currency launched by the Reserve Bank of India and what role it plays in the economy. The e-rupee holds the same status as physical money. It's official legal tender, just like the cash we use every day. This means it's fully recognized and accepted for all transactions. Understanding this helps us see how digital currency is becoming a seamless part of our financial system. It's not just virtual, it's real money, with all the same rights and responsibilities. Let's talk about the agencies involved in assessing creditworthiness. We have the Finance Ministry, SEBI, credit information companies, and credit rating agencies. But which one actually generates the numerical credit scores, like the ones from CIBIL, that help evaluate an individual's credit health? The answer lies with credit information companies. They collect and analyze data to produce those crucial credit scores we rely on. Let's clarify the difference between CICs and CRAs. CICs give us numerical scores that focus on individuals, a precise number that sums up creditworthiness. On the other hand, CRAs use alphabetical ratings to evaluate institutions or financial instruments, like bonds. So one is about people, the other about organizations or products. Understanding this distinction helps us interpret credit information more accurately. Let's talk about front-running, an unethical trading practice that happens when a trader acts on information before others can. This could be public news, government policy changes, non-public details about big upcoming orders, or shifts in the repo rate. The key issue is using that knowledge to trade ahead, gaining an unfair advantage. Understanding these triggers helps us spot and prevent front-running in the markets. Let's talk about front-running. It happens when someone uses privileged information about a big trade coming up to get an unfair edge. In other words, they jump ahead of the trade to profit from what they know before others do. This practice is considered unethical and is illegal in many markets. Understanding front-running helps us spot unfair advantages and keep trading fair for everyone involved. Participatory notes, or P-notes, are financial instruments used mainly by foreign investors who want to invest in Indian markets without going through the full registration process with SEBI. While domestic retail investors, small farmers, and the central government have their own borrowing and investment channels, P-notes specifically cater to those foreign players seeking a simpler entry point. This tool helps them participate more easily, while still complying with market regulations. These are offshore derivative instruments designed for foreign investors. They use registered intermediaries as a route to make their investments. This setup helps manage regulatory requirements while providing access to certain markets. It's a way to navigate complex investment landscapes through authorized channels. Understanding this helps clarify how international investment flows are structured and controlled. The Capital Adequacy Ratio, or CAR, is a crucial measure for banks. It ensures they have enough capital to cover risks and protect depositors. This means banks can absorb potential losses without collapsing. It's not about paying high interest or building new branches, and it's not about lending abroad. Instead, CAR is all about financial stability, making sure banks stay safe and sound, even when times get tough. Let's talk about CAR. That's the Capital Adequacy Ratio. It's a key part of the Basel norms, which are global banking regulations. CAR measures a bank's capital in relation to its risk-weighted assets. In other words, it checks whether a bank has enough capital to cover the risks it's taking on. This ratio helps keep banks safe and stable, protecting both the bank and the wider financial system. The correct answer here is C. Let's talk about what a neobank really is. It's not a bank for just one type of customer, like only lending to older people, or one that deals exclusively in gold. It's also not a specialized bank for a specific sector, like nuclear. Instead, a neobank is a technology partner to a bank, offering fully digital services without any physical branches. It's banking built for the digital age, designed to be fast, flexible, and accessible anytime, anywhere. Neobanks are digital-only platforms that don't hold their own banking licenses. Instead, they team up with licensed banks to provide their services. This approach lets them focus on user experience and technology, while the partner banks handle the regulatory side. It's a model that's reshaping how we think about banking in the digital age. Now, let's dive into how this fits within the broader topic of the external sector and exchange rates. Let's look at how currency depreciation affects trade. When a country's currency loses value, its exports usually become more expensive or cheaper. And what about imports? Do they get more expensive or cheaper? This question asks us to fill in those blanks. Understanding this helps us grasp how exchange rates influence global trade flows and a country's economy. It's a key concept in international finance. When a home currency loses value, it changes the way we buy and sell across borders. It means fewer foreign dollars are needed to buy goods made at home. At the same time, if you're buying from abroad, you'll need more of your own currency, in this case, rupees, to pay for those foreign goods. This shift affects trade balances and how competitive domestic products are on the world stage. It's a key concept in understanding currency fluctuations and their impact. The Mundell-Fleming trilemma is a fundamental concept in international economics. It tells us that a country can't have all three of these at once: free capital flows, stable exchange rates, and an independent monetary policy. You have to choose two and give up the third. This trade-off shapes how countries manage their economies in a globalized world. Today, we're exploring why this trilemma matters and what it means for economic policy. When it comes to national priorities, there's a tough trade-off we have to face. A country can only pick 2 out of 3 key goals. It's simply not possible to achieve all 3 at the same time. This means making clear choices about what matters most, knowing that one objective will have to be set aside. It's a balancing act, and understanding this helps us see why some policy decisions are so challenging. Reflation is a deliberate government policy aimed at stimulating the economy. The key goal is to boost demand and reduce unemployment during a slowdown. It's about encouraging growth when things are sluggish. Other options like fixing exchange rates, stopping factory production, or reducing population don't fit the purpose of reflation. So, when we talk reflation, think of it as a targeted effort to breathe life back into an economy that's losing steam. Reflation is all about giving a struggling economy a boost. It uses expansionary measures, like increased government spending or lower interest rates, to push growth back up. Think of it as reinflating the economy after it started to shrink or slow down. This approach aims to bring things back to a healthier level, without overheating or causing long-term inflation. It's a careful balance, but an important tool when the economy needs a lift. In a managed float exchange rate system, the value of the currency isn't left to the market alone. Instead, it's mostly guided by market forces, but with a twist, central banks step in from time to time. They do this to keep things stable, preventing wild swings that could disrupt the economy. So, it's a mix. Markets set the tone, but governments keep a watchful eye, ready to intervene when needed. This balance helps maintain order in an otherwise unpredictable world. India's approach balances free markets with careful oversight. Market forces generally drive the system, but the Reserve Bank of India steps in when things get too volatile. Their role is to smooth out sharp swings, keeping the economy steady without stifling growth. This mix of freedom and intervention helps maintain stability in a complex and rapidly changing environment. It's a system that aims to harness the best of both worlds. A current account deficit happens when a country spends more on imports and transfer payments than it earns from certain key sources. Specifically, it means the total value of imports and transfers is greater than the combined value of government tax revenue, exports and transfer receipts, gold reserves, or national savings. This slide asks us to identify which of these sources the deficit exceeds. Understanding this helps us grasp how a country balances its international financial flows. Let's talk about the current account deficit, or CAD. It measures the difference between all the money coming into a country and all the money going out, specifically through external receipts and payments on the current account. In simple terms, it shows whether a country is spending more on foreign trade and services than it's earning. Understanding this gap helps us grasp a country's economic balance with the rest of the world. Here, we're looking at how different types of offenses are classified under foreign exchange rules, according to FEMA in 1999. The question asks us to identify which category these violations fall into: capital, administrative, civil, or criminal. Understanding this classification helps us grasp the legal consequences tied to foreign exchange violations and sets the stage for deeper discussions on enforcement and compliance. Here, we're looking at the difference between two agencies that sound similar but operate very differently. FERA dealt with criminal matters. It was strict, with serious consequences. FEMA, on the other hand, takes a more liberal approach. It treats violations as civil issues, focusing on resolution rather than punishment. This distinction is key to understanding how each agency functions and why their approaches matter. The correct answer here is B. Let's break down what the Reserve Tranche Position, or RTP, with the IMF really means. It's not about gold held by the Reserve Bank of India, nor is it debt the IMF owes to a country. It's also not a tax on foreign exchange. Instead, the RTP represents a country's liquid claim on the IMF, funds that can be accessed without any conditions. In other words, it's money the country can draw on freely from its IMF quota. Here, we're looking at a specific part of the quota, the portion paid in hard currency. This is the amount a member can actually withdraw when a crisis hits. It's a critical feature, designed to provide immediate access to funds when they're needed most. Understanding this helps us grasp how government schemes and recent initiatives support financial stability in tough times. The correct answer here is option B. The Aspirational District Program by NITI Aayog is all about uplifting the most underdeveloped districts. It's not about quick fixes like handing out free money or building only nuclear power plants. Instead, the focus is on bringing districts together, encouraging convergence, collaboration, and even healthy competition. This approach helps drive real, sustainable progress where it's needed most. Today, we're exploring how these strategies work to transform communities and create lasting change. We're looking at how ADP leverages real-time data and competition to boost governance in areas that have been left behind. By tapping into up-to-the-minute information, they can respond faster and smarter. Adding competition creates an environment where improvements are driven forward, even in places that face the toughest challenges. This approach helps turn slow, ineffective systems into ones that deliver real results. An inverted duty structure happens when the government sets tax rates, so that final products are taxed more heavily than the raw materials or inputs used to make them. Sometimes, it can also mean taxing raw materials higher than the finished goods. This creates a mismatch that can discourage local manufacturing or add unnecessary costs. In this question, we're exploring which scenario best describes an inverted duty structure and how it impacts trade and industry. When the cost of raw materials and components rises above the price of buying the finished product from elsewhere, domestic manufacturing struggles to compete. It simply can't match the lower prices of imports. This creates a tough environment for local producers, pushing them out of the market. That's why understanding input costs is crucial. It's often the deciding factor between making something at home or bringing it in from abroad. Let's look at the safe harbor framework in India's IT sector. Its main goal is to reduce the compliance burden and ease transfer pricing disputes. It's not about banning IT companies or providing free internet to students, and definitely not about protecting computers from rain. Instead, it's designed to create clearer rules, making life simpler for businesses operating in this space. This slide highlights a simplified tax framework. Here, the government agrees to accept a firm's declared profit margin without conducting an audit. It's a streamlined approach that reduces administrative burden and speeds up the process. Essentially, it builds trust by assuming the reported profits are accurate, cutting down on the need for detailed scrutiny. This method can benefit both businesses and tax authorities by making compliance more straightforward. Let's look at the technology behind the Swamitva scheme, which helps provide legal ownership records in rural areas. The question is, which method do they use? Is it satellite imagery alone, drone-based mapping, manual door-to-door surveys, or internet browsing history? Understanding the right technology here shows how modern tools are making a real difference in land record management. Drones play a crucial role in mapping inhabited areas, often called ABADI zones. By capturing detailed images from above, they help create accurate maps that are essential for issuing land titles. This technology makes the process faster and more precise, ensuring that communities have clear ownership of their land. It's a practical solution that combines innovation with real-world needs. Let's look at the PMWANI scheme, launched in 2020. Its main goal was to provide better access to Wi-Fi in public places. This initiative aims to make internet connectivity more affordable and widespread, especially in areas that need it most. While clean water, solar lamps, and digital tablets are vital in their own right, PMWANI specifically focuses on expanding public Wi-Fi access to bridge the digital divide. It's a key step toward a more connected society. This slide highlights an important goal, increasing Wi-Fi access by expanding public data offices. The idea is to bring connectivity to more people, especially in areas where internet access is limited. By setting up these offices, we create new points where communities can get online easily. It's a practical step toward bridging the digital divide and making sure more of us can tap into the benefits of the internet. Under the Ayushman Bharat Health Scheme, a significant majority of the beneficiaries are women. In fact, about 90% of those who receive support through this program are female. This highlights the scheme's focus on addressing women's health needs and ensuring they have access to essential medical services. It's a powerful reminder of how targeted initiatives can make a real difference in improving healthcare equity. Here, we see that nearly half of the Golden Card holders are women, 49%, to be exact. This detail highlights a balanced representation among cardholders, which is important when we think about who benefits from this program. It's a reminder that gender diversity plays a role in how opportunities are distributed. The correct answer, then, is C. Let's take a look at the UWIN portal, a new digital platform launched by the government. It's designed to serve a specific purpose, but which one? Is it for paying electricity bills, supporting online shopping for farmers, providing universal immunization services, or maybe something as unexpected as winning a lottery? This question challenges us to think about how digital platforms are shaping different areas of public service and engagement. This slide highlights a system that tracks and provides access to vaccination services nationwide. It's about connecting people to the vaccines they need, wherever they are. The focus here is on accessibility and coverage, making sure no one is left behind when it comes to immunization. This initiative plays a crucial role in public health by keeping the entire country informed and protected. The Shanti Act in India is designed to open up new possibilities by encouraging private sector involvement. It focuses on areas like free insurance for every citizen, ending all industrial licensing, allowing civil use of nuclear power, and achieving absolute silence in cities. These goals reflect a bold vision for peace and progress, blending social welfare with innovation and environmental care. Today, we're exploring how this act aims to transform these critical sectors through private participation. This slide highlights a key shift, opening the civil atomic energy sector to private investment. It's about inviting new players into a field traditionally dominated by the public sector. By doing this, we aim to boost innovation, increase funding, and accelerate development. Private investment can bring fresh energy and resources, helping the sector grow in ways that might not be possible otherwise. This move marks a significant change in how we approach atomic energy. Let's look at what really drives market efficiency, according to the invisible hand theory. Is it government planning, international aid, corporate taxes, or individual self-interest? The theory suggests that when individuals pursue their own interests, they unintentionally contribute to the overall good of the market. It's a powerful idea that personal motives can lead to collective benefits without anyone planning it. This question helps us pinpoint that key concept. Sometimes, when we pursue our own interests, we actually end up helping everyone else too. By focusing on what we want, better products, better services, we push innovation forward. This unintended effect means that individual self-interest can drive improvements that benefit society as a whole, even if that wasn't the original goal. It's a powerful idea that shows how personal motivation and the common good can align. Laissez-faire economics supports a minimalist state, one that steps back and limits its role. It focuses mainly on maintaining law and order and protecting property rights. It doesn't control factories or fix prices for essential goods, nor does it aim to distribute wealth equally. Instead, it trusts markets to operate freely, with the state acting as a referee rather than a player. This approach believes less intervention leads to more efficient outcomes. A minimalist state is one that keeps its role tightly focused, mainly on protecting safety and property rights. Everything else, from services to economic activity, is left to the market to handle. This approach trusts that less government intervention can lead to more freedom and efficiency. It's a clear, pared-down vision of what a state's core job really is. Public goods have a unique quality: they're non-excludable. That means you can't easily stop people who don't pay from using them. It's not that only the rich can access them, or that one person's use takes away from another's. And they're not always produced by private companies. The key point is that once a public good is available, it's tough or costly to exclude anyone from benefiting. That's what sets them apart. Let's talk about non-excludability, a defining feature of public goods. This means you can't prevent anyone from using them. Take clean air or justice, for example. Everyone benefits whether they pay or not. That's why these goods are so different from private ones. They're available to all, and that's what makes managing them a unique challenge. Let's look at different types of economic systems: capitalist, mixed, socialist, and laissez-faire. The question here is, in which system does the state have dominant control over production and resources? It's about who calls the shots, the government or the market. Understanding this helps us see how economies organize themselves and who holds the power to decide what gets made and how. Think about the role of the state in each system as we move forward. In socialism or command economies, the government takes the lead in deciding what gets produced and where investments go. It's a top-down approach. The state plans and directs resources to meet its goals. This contrasts with market economies, where supply and demand play the central role. Understanding this helps us see how different systems organize their economic activity. The correct answer here is C. India is called a mixed economy because it combines different approaches. It allows both public and private sectors to own and run businesses. This blend lets the country benefit from government involvement and private enterprise. It's not limited to just importing goods, nor does it lack government. And it certainly doesn't follow only ancient traditions. The key idea is balance, mixing various economic roles to support growth and development. In India, the economy is a blend of government control and private enterprise. The government steps in to manage strategic sectors, areas vital to national interests. Meanwhile, private businesses operate freely in many other industries, driving innovation and growth. This balance allows the country to protect key resources while encouraging entrepreneurship and competition elsewhere. It's a unique approach that shapes how India's economy functions today. The paradox of thrift is a curious idea in economics. It suggests that if everyone tries to save more at the same time, the total savings in the economy might actually go down. Why? Because when people save more, they spend less, which can slow down the economy. This slowdown can reduce incomes, meaning there's less money overall to save. So even though the intention is to save more, the result can be the opposite. It's a powerful reminder of how individual actions add up in complex ways. When people save more, they spend less. That drop in spending means overall demand in the economy falls. With less demand, businesses produce less, output goes down. And that lower output can lead to reduced income in the future, creating a cycle that slows growth. So, while saving is good for individuals, on a large scale, increased saving can actually hold back the economy. This idea helps us understand why the right balance between saving and spending is so important. Let's break down how net domestic product, or NDP, is calculated. It starts with GDP, or gross domestic product. From there, we subtract depreciation. That's the wear and tear on capital goods over time. So NDP equals GDP minus depreciation. The slide also shows some related terms like GNP plus subsidies, or GDP plus taxes. But for NDP, the key is adjusting GDP by removing depreciation. It's a way to measure the economy's net output after accounting for the cost of keeping things running. Here, we're looking at how the net domestic product, or NDP, accounts for the wear and tear on capital goods. This wear and tear is what we call depreciation. It's important because it shows the real value of what's produced after replacing or maintaining the equipment and infrastructure we use. So, when we subtract depreciation from the total output, we get a clearer picture of the economy's actual productive capacity. The correct answer here is B. Let's look at a key concept in economics: transfer payments. These are payments made without any goods or services being exchanged in return. For example, salaries of soldiers, profits from a bakery, and export revenue all involve actual production or services. But remittances from relatives abroad, those are transfer payments. They're simply money sent from one person to another, and because no new goods or services are produced, they're typically excluded from GDP calculations. Here, we're clarifying why certain types of transfer payments, like remittances or lottery winnings, are excluded from measures of current production. These payments don't reflect new goods or services being created, they're simply moving money around. So when we talk about economic output, these transfers don't count. This distinction helps keep our calculations focused on actual production, making the data more accurate and meaningful. The correct answer here is C. Let's talk about the managed float exchange rate system. It's often called by a few different names: clean float, dirty float, fixed float, or hard float. Each term highlights a slightly different approach to how currencies are allowed to move in the market, with varying levels of government intervention. Understanding these labels helps us grasp the balance between market forces and policy control in currency management. This question asks us to identify which of these terms best fits the managed float system. Sometimes, central banks step in to influence the market instead of letting it run completely on its own. This occasional intervention is why we call it a dirty system. It's not about a free market acting without interference. The central bank's actions create a mix of control and market forces working together. This approach helps stabilize things, but also means the market isn't purely left to its own devices. The correct answer here is B. Under the 1956 Industrial Policy Resolution, industries were categorized based on who could operate them. Schedule A industries were exclusively reserved for the state. That means the government had full control. Other categories allowed for a mix of public and private involvement, or were open only to the private sector. This classification shaped how India's industrial landscape developed for decades. Understanding these categories helps us see the balance between government control and private enterprise at that time. Here, we're looking at Schedule A industries, those sectors that were once completely controlled by the state, operating under an exclusive monopoly. This means private players had no access at all. The correct answer in this case is B. Understanding this distinction helps us see how government control shaped the industrial landscape. It's a key piece in the puzzle of economic history. Let's talk about the term Hindu rate of growth. It describes India's slow economic growth, stuck around 3.5% for a long time. But who actually coined this phrase? Was it Manmohan Singh, Amartya Sen, Raj Krishna, or P.C. Mahalanobis? This question points us to the economist who first captured this challenging period in India's development story. It's a key moment in understanding the country's economic history. Raj Krishna coined a term to describe a period of slow economic growth between 1950 and 1980. This era was marked by steady but modest progress, rather than rapid expansion. Understanding this timeframe helps us see how growth patterns can shift dramatically over decades, influenced by various social and economic factors. It's a key concept when studying economic history and development trends. Let's break down what revenue expenditure really means in government spending. It's not about creating long-term assets. That's a different kind of spending. It doesn't reduce liabilities like salaries or pensions either. Instead, revenue expenditure covers the day-to-day costs that keep things running. It's the spending that doesn't add to the government's assets, but is essential for maintaining current services and operations. Understanding this helps us see how budgets are structured and where money is going. Here, we're looking at spending that covers the daily running of government services. This includes everything needed to keep things moving smoothly, like salaries, office supplies, and routine maintenance. It's not about big projects or investments, but the essential costs that happen every day. Understanding this helps us see where resources go and how the government stays operational. The correct answer here is C. Let's look at when the term effective revenue deficit was added to the FRBM Act. This question asks us to identify the specific amendment year. The options range from 1991 to 2024, covering key moments in financial regulation. Understanding this helps us track how fiscal responsibility measures have evolved over time and how the concept of revenue deficit management has been formalized in law. It's a detail that connects policy changes to their historical context. Let's take a moment to talk about the ERD concept. It was introduced as part of the 2012 amendment, marking a significant update. Understanding when and how these ideas came into play helps us see the bigger picture. In this case, the correct answer is C. That's the key takeaway for this slide. Let's break down what a primary deficit of zero really means. It tells us that the government's current spending, excluding interest on past debt, matches its revenue exactly. In other words, the government isn't borrowing to cover new expenses. Any deficit we see comes solely from interest payments on existing debt. So, either the government has no debt, or all it's borrowing is just to pay interest, not new spending. This distinction is key to understanding fiscal health. Let's break this down. Since the principal difference equals the face value minus interest, a zero principal difference means all the borrowed money is just covering the old interest. In other words, no extra principal is being paid back. That's why the correct answer here is B. It's a subtle point, but it's key to understanding how borrowing and interest interact in this context. Countercyclical fiscal policy is all about how the government adjusts its spending when the economy takes a downturn. During a recession, the government doesn't hold back. It actually increases spending. This helps to stimulate the economy, offsetting the drop in private sector demand. So, the right answer here is that the government increases spending when times get tough, aiming to smooth out the economic cycle rather than letting it spiral downward. When the economy slows down, the government steps in to break the cycle. Instead of pulling back, it actually increases spending. This approach helps stabilize things, putting money into the system when it's needed most. It's a way to smooth out the highs and lows, preventing deeper downturns and supporting recovery. This strategy is a key tool for managing economic swings. Let's talk about direct taxes. These are taxes where the burden, or what we call the incidence and impact, falls on the same person or entity. In other words, the person who pays the tax is the one who ultimately bears the cost. This slide asks us to consider who exactly that is. Is it different people, the same person, only foreign firms, or just the government? Understanding this helps clarify how tax systems affect individuals and organizations. Here, we're looking at a key principle in taxation, the idea that the person who is charged the tax is the one who has to pay it. It can't simply be passed on or shifted to someone else. This means the legal responsibility for the tax lies squarely with the individual or entity levied. Understanding this helps clarify who ultimately bears the burden of a tax. In this case, the correct answer is B. In outcome budgeting, we shift our focus away from just the money allocated, the outlays, and instead look at what really matters. That means paying attention to the total taxes collected, the number of employees hired, and most importantly, the actual developmental impacts and results. It's about measuring the real-world outcomes, not just the spending. This approach helps us understand if the resources invested are making a meaningful difference. This approach focuses on what we actually get for the money spent, not just the amount spent itself. It's about measuring outcomes, the real impact, rather than simply tracking expenses. By prioritizing results, we ensure resources are used effectively, delivering value, and making a difference. This shifts the conversation from cost alone to the true benefits achieved. That's why option C is the correct answer here. Let's look at the factors that influence the money multiplier. We have 4 options here: total population, reserve deposit ratio, price of gold, and export growth rate. The key idea is that the money multiplier moves in the opposite direction to one of these. In other words, when that factor goes up, the multiplier goes down. Think carefully about which one restricts or expands the money supply. That's the one that's inversely related. When reserve requirements go up, banks have to hold onto more money instead of lending it out. That means they can't create as many loans, which shrinks the multiplier effect, the process where $1 of reserves supports multiple dollars of lending. So, higher reserve requirements tighten the flow of credit in the economy. This is why option B is the correct answer here. Open market operations, or OMOs, come in different types depending on their purpose. When the central bank permanently buys government securities, these are called outright OMOs. Other types include repo OMOs, reverse repo OMOs, and moral OMOs, each serving a specific role in managing liquidity and interest rates. Today, we're focusing on outright OMOs, the permanent purchases that directly impact the money supply. Understanding these distinctions helps us see how central banks steer the economy. Outright open market operations, or OMOs, lead to a lasting shift in the overall liquidity of the financial system. Unlike temporary measures, these actions permanently adjust the amount of money available. This change can influence interest rates and economic activity over the long term. Understanding this helps us see why outright OMOs are powerful tools in monetary policy. Let's talk about front-running, a practice that's definitely not okay. It's an unethical and illegal move in trading, where someone uses insider knowledge to get ahead of client orders. Bank managers have a clear obligation to avoid this. So, front-running isn't an ethical strategy, nor is it just part of the usual process. It's a serious violation that undermines trust in the market. This slide highlights a key concept in trading. It's about making decisions based on information that isn't public yet. Specifically, it involves acting on knowledge of large orders that are about to happen. This kind of trading raises important ethical and legal questions, because it gives some traders an unfair advantage over others who don't have that insider insight. Understanding this helps us see why transparency matters in the markets. When we talk about neobanks, there's one thing they absolutely need: a partnership with a traditional bank. They can't operate on their own. So what does that bank need to have? It's not about a high stock price or a gold vault or even an international presence. The key requirement is a banking license from the Reserve Bank of India. Without that, a neobank simply can't function. This partnership is what makes the whole system work. Neobanks aren't banks in the traditional sense. Instead, they're tech partners that operate using a licensed bank's legal framework. This means they focus on delivering innovative services, while the licensed bank handles the regulatory side. It's a partnership that blends technology with compliance, letting neobanks move fast without skipping the legal essentials. This approach is what sets them apart in the financial landscape today. Let's talk about the different tools in India's liquidity adjustment framework: the repo, MSF, SDF, and the bank rate. Since 2022, the so-called LAF floor has been set by one of these rates. This floor acts as a baseline for short-term interest rates in the market. Understanding which rate sets this floor helps us grasp how monetary policy steers liquidity and borrowing costs in the economy. Let's talk about SDF. It's now the main non-collateralized floor for absorbing liquidity. That means it acts as a safety net, soaking up excess liquidity without relying on collateral. This role is crucial because it helps stabilize the system, keeping things balanced when markets get volatile. Understanding this shift is key to grasping how liquidity flows are managed in today's environment. The correct answer here is C. Let's talk about the digital rupee, or e-rupee, and its status compared to other forms of value exchange. The question here is, what does the e-rupee stand on equal footing with? Is it foreign aid, stock options, physical currency, or private coupons? Understanding this helps us see how digital currency fits into the broader financial system and why it matters for everyday transactions and policy decisions. This slide confirms that the currency in question is official legal tender, issued by the Reserve Bank of India. That means it's recognized by law for all financial transactions in the country. The correct answer here is option B, emphasizing the authority and legitimacy of the RBI in issuing currency. It's a key point in understanding how currency systems are regulated and trusted. The Mundell-Fleming trilemma is a key idea in international economics. It tells us a country can't have all three of these at once: free capital flow, an independent monetary policy, and stable exchange rates. One of these has to give. This slide asks us to fill in the blank, which option completes the trilemma alongside the other two. It's a classic puzzle about the trade-offs nations face in managing their economies. Here, we see a clear statement. Achieving all three goals at the same time is simply not economically possible. This reminds us that in complex decisions, trade-offs are inevitable. We can't have everything perfectly balanced without some cost or compromise. The correct answer, then, is option C, the one that acknowledges this reality. It's a crucial point to keep in mind as we navigate challenges that demand tough choices. Here, we're looking at different categories of offenses under FEMA from 1999. The key point is that FEMA shifted the way violations were treated, moving away from criminal charges under the earlier FERA, and instead classifying them as civil offenses. This change had a big impact on enforcement and penalties, making the approach more administrative and less punitive in a criminal sense. It's an important distinction to understand in how regulations evolved. FEMA has shifted its approach, moving away from the harsh criminal penalties it once enforced. This change reflects a more balanced way of handling issues, focusing less on punishment and more on constructive solutions. It's a significant step in how the agency operates, aiming to be fairer and more effective in its response efforts. Let's talk about the concept of an inverted duty structure and how it impacts domestic manufacturing. The question here is whether this structure makes domestic manufacturing illegal, self-sufficient, uncompetitive, or highly competitive. Understanding this helps us see how trade policies and tariffs can either support or challenge local industries. It's a key piece in the puzzle of economic strategy and global trade dynamics. When we tax raw materials more than finished products, it creates a barrier for local industries to add value. Instead of encouraging businesses to process and manufacture locally, it pushes them to import finished goods. This approach can stunt economic growth and limit job creation. So, the key takeaway here is that taxing raw materials higher than final goods actually discourages local value addition, and that's something we want to avoid. Let's look at a question about taxation, specifically, the safe harbor framework. This concept is tied to one of these issues: property tax, transfer pricing, wealth tax, or import duties. The safe harbor rules are designed to provide clarity and predictability in tax matters, often by setting simplified standards or thresholds. Understanding which area this framework applies to helps us grasp how tax authorities manage complex transactions and prevent disputes. So, which one do you think it is? This slide highlights a key benefit: simplifying tax compliance for companies managing their own subsidiaries. When firms have multiple branches or entities, keeping track of tax rules can get complicated fast. This approach makes that process smoother and less prone to errors. It's about cutting through complexity so businesses can focus on growth, not paperwork. That's why this point is the correct answer here. Let's talk about the Swamitva scheme and the type of rural land it focuses on. This initiative is all about mapping inhabited, or abadi, land in villages. That means the areas where people actually live, their homes and settlements. It's not about forests, deserts, or agricultural fields. Mapping inhabited land helps clarify property ownership and supports better planning and development in rural communities. So the key focus here is on the places where people make their homes. This slide highlights how the system assigns titles to the residential areas within villages. It's about giving each neighborhood a clear identity, making it easier to navigate and understand the layout. Naming these areas helps create a sense of place and community, which is essential for both residents and visitors. So, the correct answer here is C, focusing on providing titles for these residential zones. Here, we're looking at a question that asks which COVID-era portal inspired the design of the UN portal. The options include Arajya Setu, CoWIN, Gati Shakti, and PM Kisan. Each of these played a significant role during the pandemic, but one served as the model for this new initiative. This question helps us connect past digital responses to current innovations. We're looking at how UN takes a page from CoWIN's playbook, digitizing universal immunization records. Just like CoWIN transformed the way COVID vaccines were tracked and managed, UN aims to do the same for all immunizations. This means easier access, better record keeping, and a smoother experience for everyone involved. It's a big step toward modernizing healthcare data, making it more reliable and more accessible. Here, we see the results for question 80, which asks about the increase in the FDI limit for insurance companies. The answers show a clear winner, option C, with 100% of responses. Options B and A received fewer votes, and option D got none at all. This tells us that most people are confident the limit has been raised to the level indicated by option C. It's a good checkpoint to understand how well this fact is known. We've seen a significant change in the recent reforms. The limit was raised from 74% all the way up to 100%. This shift means there's now full allowance where there used to be a cap. Understanding this update is key to grasping the current rules and how they impact the system. It's a clear example of how policy evolves to meet new needs. Let's talk about Adam Smith's idea of the division of labor. When tasks are divided, what's the main result? Is it stress, costs, government oversight, or productivity through specialization? Smith argued that breaking work into specialized parts boosts productivity. It's not about creating more stress or increasing costs. It's about making each worker more efficient at their specific job. This focus on specialization is what drives greater output overall. When we split tasks, something interesting happens. Workers get faster and more efficient. By breaking down work into smaller parts, each person can focus on what they do best. This specialization speeds things up and improves quality. It's a simple idea, but it has a big impact on productivity and teamwork. In a command economy, the usual drivers of prices and production don't apply. Instead, the government plays the central role. It sets prices and decides what gets produced. Unlike markets or consumers making those choices, it's the state that directs economic activity. So, while consumers, market forces, and individual firms matter in other systems, here, the government calls the shots. This slide asks us to identify that key player in a command economy. Here, we're looking at a system where the government takes the lead in planning and controlling the entire economy. This means decisions about production, distribution, and pricing are made centrally, rather than by individual businesses or market forces. It's a top-down approach, where the state sets the direction and manages resources to meet its economic goals. This kind of control shapes how goods and services are allocated across the country. Public goods have a unique quality: they're non-rivalrous. That means one person using them doesn't take away from anyone else's ability to use them. Unlike private goods, where if I have it, you can't, public goods are available to all simultaneously. This slide helps us understand common misconceptions, like thinking they're only for the rich or very expensive, which isn't the case. The key takeaway is that public goods can be shared without running out. Some goods share a special quality: they're available to everyone, no matter who you are or where you live. Clean air and national defense are perfect examples. These goods can't be withheld from anyone, and one person's use doesn't reduce what's left for others. This core trait shapes how we think about providing and protecting them, and it's what makes them so essential to society. When we look at the GDP deflator, it's important to understand what it actually measures. Unlike the Consumer Price Index, which focuses on a fixed basket of goods, the GDP deflator covers all domestically produced final goods and services. This means it reflects price changes across the entire economy, not just a selection. Because of this broader scope, the GDP deflator is often seen as a more comprehensive measure of inflation. It's not limited to food, imports, or luxury items. It's the full picture. Unlike the fixed basket used in the Consumer Price Index, the deflator takes a broader view. It measures the prices of everything produced within the economy, capturing a more comprehensive picture of inflation. This makes it a flexible and dynamic tool, reflecting changes in the mix of goods and services over time. So, when we want to understand overall economic price shifts, the deflator gives us a fuller story. When we talk about green GDP, we're looking beyond traditional measures of economic growth. It adjusts for ecological costs by subtracting things like pollution. But it doesn't stop there. It also accounts for other factors that impact the environment and resources. These include labor costs, natural resource depletion, interest payments, and tax revenue. Understanding these deductions helps us see the true economic impact on the planet, not just the numbers on a balance sheet. This slide highlights a key idea: that environmental health is closely linked to economic output. It's not just about dollars and cents. It's about how well our environment is doing as we grow economically. When we measure progress, we need to consider both. That balance is crucial for sustainable development. So, the correct answer here is B, because it captures this connection clearly. When we talk about a revenue deficit, we're looking at a specific financial situation for the government. It means the government is borrowing money to cover its regular, day-to-day expenses, things like consumption and operational needs. This isn't about big projects or paying off debt. Instead, it shows that the government's income isn't enough to meet its routine spending. Understanding this helps us see where borrowing is happening and why. Here, we see the government is actually dissaving. That means it's dipping into its savings or borrowing to cover everyday costs, like paying salaries. Instead of building reserves, it's spending more than it earns in the short term. This approach can work temporarily, but it's a sign of financial strain if it goes on too long. It's a key point to understand when looking at how governments manage their budgets. Let's talk about the primary deficit, a key concept in understanding government finances. The primary deficit hits zero when the total fiscal deficit matches the sum of certain costs. These include subsidies, interest payments on past debt, tax revenue, and export earnings. Essentially, it means the government's borrowing is just covering interest and other obligations, without adding new debt from current spending. This helps us see how much of the deficit is driven by past commitments versus new expenses. Here, we see that the government isn't borrowing to fund new projects or expenses. Instead, it's borrowing solely to pay off existing debt, to service old loans. This approach keeps the debt cycle going but doesn't add to it. It's a key point in understanding how government borrowing works in this context. The correct answer, then, is B. Direct taxes have a few key characteristics that set them apart. They're paid in cash, usually directly by the individual or entity. They're calculated by the government based on income or assets. And importantly, they they can't be shifted to someone else. The person responsible for the tax is the one who ultimately pays it. So, direct taxes are linked closely to income and personal responsibility, making them quite distinct in how they function. When it comes to direct taxes, like income tax, the key point is this: the burden always stays with the taxpayer. That means the person who earns the income is the one who ultimately pays the tax. It doesn't get passed on to someone else. This is what sets direct taxes apart from indirect ones. So, in this case, the correct answer is B. Let's talk about tax buoyancy and how it's different from tax elasticity. Tax buoyancy looks beyond just inflation or specific sectors. It captures the overall impact of things like government policy changes and shifts in the economy. Unlike tax elasticity, which measures how tax revenue responds to changes in income alone, buoyancy considers multiple factors that influence tax collections. This broader view helps us understand how tax revenue grows or shrinks in real-world conditions, not just in theory. It's a key concept when analyzing global trade trends and fiscal policy. Buoyancy looks at how tax revenue shifts as national income changes, but it doesn't stop there. It also factors in the impact of new tax laws. So, it's a broader measure than just elasticity, capturing the real-world effects of policy changes on revenue. This helps us understand the full picture of how tax income responds to economic growth. Let's talk about the money multiplier, a key concept in banking and finance. It grows larger when the reserve requirement for banks goes down. That means banks can lend out more of their deposits, creating more money in the economy. This slide highlights the connection between reserve requirements and how much money banks can effectively multiply through lending. Understanding this helps us see how monetary policy influences the flow of money. When banks hold lower reserves, they're able to lend out more money. This lending doesn't just move cash around, it actually multiplies the initial money base. In other words, a smaller reserve requirement means more loans, which means more money circulating in the economy. This concept is key to understanding how banks influence the overall money supply. The correct answer here is B. Here, we're looking at the concept of moral suasion, a tool used by the Reserve Bank of India. Instead of relying on strict legal mandates, moral suasion involves using persuasion and pressure to influence behavior. It's about guiding decisions through encouragement rather than force. So, the key idea is that the RBI prefers to nudge rather than command, relying on influence over regulation in certain situations. This slide highlights a qualitative tool designed to guide banks in following their credit policies. It's not about numbers or formulas, it's about sound advice and best practices. The goal is to help banks make better lending decisions by sticking to clear, consistent credit standards. This approach supports stability and reduces risk, ensuring that credit policies aren't just written down, but actively followed. Let's talk about the term repo. It stands for repurchase agreement, a contract where one party sells securities and agrees to buy them back later, usually at a higher price. This slide breaks down some key concepts around repos, like the resource pool, repayment options, and repurchase obligations. Understanding these elements helps us see how repos function as short-term loans in financial markets. It's a crucial piece of the puzzle when managing liquidity and risk. Let's talk about what a repo really is. It's a short-term borrowing tool where collateral is used to secure the loan. Think of it as a way to borrow money quickly, with an asset held as a guarantee. This mechanism helps keep markets liquid and functioning smoothly. In this case, the correct understanding is that a repo is indeed a short-term collateralized borrowing method. Here, we're looking at who issues the digital rupee. The options include the Finance Ministry, SEBI, RBI, and SBI. The key point is that the digital rupee is issued by the Reserve Bank of India, or RBI. This highlights the central bank's role in managing the country's digital currency, ensuring trust and regulation in this new form of money. Understanding this helps us see how digital currency fits into the larger financial system. Here, we're looking at a key distinction in issuing digital currency. Unlike the I-1 note, which comes from the Finance Ministry, the e-rupee is issued by the Reserve Bank of India, the RBI. This difference matters because it highlights who holds the authority and responsibility for this new form of money. Understanding this helps us grasp the structure behind digital currency issuance in India. Let's consider the idea of currency devaluation, a deliberate move by a country to reduce the value of its currency. The question here is, under which system does this happen? Is it a floating exchange rate, a fixed exchange rate, the barter system, or a socialist system? We're focusing on how governments or central banks might intervene in currency values and which economic framework allows for that kind of action. This sets the stage for understanding exchange rate policies. Let's clarify the difference between devaluation and depreciation. Devaluation is an official move. It's when an authority, like a government, decides to lower the value of its currency. Depreciation, on the other hand, happens naturally in the market, driven by supply and demand. This distinction matters because one is deliberate, the other is organic. So when we talk about currency value changes, it's important to know who's calling the shots. When we talk about reflation, we're referring to policies aimed at boosting economic activity after a downturn. So, which type of fiscal and monetary approach gets us there? The answer lies in expansionary policies. These are designed to increase spending, lower interest rates, and stimulate growth. They're the opposite of contractionary measures, which slow things down. Reflation isn't neutral or protectionist either. It's all about pushing the economy forward, helping it recover and grow again. This slide highlights the main goal of the strategy, to boost demand and help recover from a slowdown. When demand picks up, it sets the stage for growth and stability. The correct answer here is C, which aligns directly with that purpose. It's all about reigniting interest and activity to move past the slowdown and back into momentum. Let's talk about stagflation. It's a tricky economic term that combines two things, stagnation and inflation. Stagnation means the economy isn't growing much, if at all. Inflation means prices are rising. So stagflation happens when the economy is stuck, but prices keep going up. It's a tough spot because usually, inflation and growth move in opposite directions. Understanding this helps us see why some economic problems are so stubborn. This slide highlights a specific economic condition, one where growth is unusually low, yet prices keep climbing. It's a tricky situation because normally, low growth would mean prices stay steady or even fall. But here, they rise, creating a challenge for policymakers and businesses alike. This condition is often called stagflation, and understanding it helps us grasp why some economic problems are so persistent and complex. Here, we're looking at how FEMA, introduced in 1999, changed the way foreign exchange was managed compared to its predecessor, FERA. The question asks us to fill in the blank. FEMA was designed to handle foreign exchange more strictly than FERA. This means tighter controls and clearer regulations, reflecting a shift toward more disciplined management in this area. It's a key point in understanding how financial governance evolved over time. FEMA shifted its approach to focus more on management and civil penalties. This means they're emphasizing accountability through structured oversight and fines, rather than just other enforcement methods. It's a move toward clearer, more consistent consequences when rules aren't followed. This framework helps ensure organizations take responsibility seriously, making the system fairer and more effective overall. Let's talk about the inverted duty structure, a situation where import duties are higher on raw materials than on finished goods. This setup hurts domestic manufacturers, especially those making products locally. When inputs cost more because of these duties, it raises their expenses and makes it harder to compete. So, the answer here is domestic manufacturers. They're the ones most affected by this kind of trade policy. When local production adds value but still can't compete with finished imports, it creates a real challenge. This situation means that no matter how much effort goes into improving local goods, imported products often win out because they're already complete and ready to use. That's why this issue is so critical. Making local value addition uncompetitive puts the entire supply chain at risk. Understanding this helps us see why focusing on competitiveness at every stage is essential. The Aspirational District Program, or ADP, depends on a certain style of governance to make progress happen. This slide asks us to consider which approach best drives improvement. Is it centralized control, focusing on outcomes, involving the military, or relying on voluntary participation? Understanding this helps us see how the program encourages districts to take charge and improve from within, rather than just following top-down orders. Let's think about which option fits the program's spirit best. Here, we see a method that relies on data and rankings to assess developmental outcomes. It's a way to measure progress by looking at clear, comparable results. This approach helps us understand where things stand and what's working or not. The correct choice in this case is option B, which aligns with this data-driven evaluation. Outcome budgeting helps us figure out if a project actually achieved what it set out to do. It's not just about tracking costs or dates, it's about measuring the real objectives and impacts. So, the key question here is whether the intended results were met, not just the inputs or timelines. This approach shifts the focus from spending to outcomes, making sure every resource drives meaningful progress. As we wrap up, remember that focusing on real-world results, not just spending, is what truly measures success. It's about the objectives and the impact we create. That's where the real value lies. Thanks for joining me on this journey. This video was